I am here with William Silber, a former professor of finance at NYU Stern, currently senior advisor at Cornerstone Research. Now, Bill, the reason I have you on this is because you are publishing a book called The Power of Nothing to Lose. Subtitle, The Hail Mary Effect in Politics, War, and Business. It is being put out by HarperCollins and is available for people to order. And we'll put that link in the show notes later on. But to start off, maybe, and I read the preview of the book, but maybe you can just, in your own words, kind of tell us a little bit what this is about and what this means for risk from an investment perspective.
Yeah, so the best way to get into this, I think, is to explain how this book got started. I've been thinking about it for a long time, 30 years, while teaching at NYU. I teach a course in investments, which is how to choose among different securities, stocks, bonds, and real estate. And I quickly realized that the same principles apply to normal people and generals, presidents, making decisions under uncertainty. And the one focal point that jumped out was when people have downside protection, limited losses, they tend to become reckless and almost gamblers. And this became important during the course, which was kind of technical and mathematical. Students get tired of that. So I invented a little game towards the end of the semester that would divert their attention a little bit. And that is, I took a list of 10 securities, commodities, and asked them to choose the one that had the biggest profit over the last month of class. And if they chose correctly, they would get 1.5 points added to their grade. And if they chose incorrectly and got a bad one, nothing would happen except we would sympathize with them. So the question is, how do they choose? What's the strategy? Well, of course, some of them try to guess about prices, which is a fool's game. Nobody knows which way prices are going to go. So what's the strategy? And the optimal strategy turns out to pick the security that has the biggest volatility. Today, that would be Bitcoin. Why is that? Well, that gives you the biggest possible upside. It also gives you the biggest possible downside, but who cares about the downside? Why? You don't lose points on the exam for picking the worst. So the best strategy would be pick the riskiest security. Back then it was crude oil. Today it would be Bitcoin, and that's all because of downside protection.